Mehta joins us. Let's say hello and good morning to him. And where is the umbrella? It's raining.
It's pretty much dry just now.
Actually didn't buy my umbrella. I just thought, okay, June aayega umbrella kharidenge. And then suddenly you realize that, it's raining, it's pouring. What are your thoughts on early monsoon and what it means for the market, what it means for the economy, what it means for inflation? Everybody's trying to, think through it now.
Well, all I can say that the early monsoon has really dampened our investment theme of buying summer stocks. So we are bullish on ice cream manufacturers, air conditioners, air coolers. All of those revenues are going to get hit. And these are very weather sensitive industries, companies. And, the monsoon coming in so early is going to impact their revenues, and they're anyway dealing with a high base effect. So in a way, that is kind of a bit of a negative for those stocks. But I think on the whole, it's pretty much fine that we are expecting a normal monsoon. And it does seem now that once we are over and done with the Trump tariff tantrums, there seems to be some kind of a blue sky scenario for the stock markets. There never usually is, but at least it seems so sitting on this side that we are done with inflation problems, we're done with interest rate related issues, and even geopolitically, whatever events were there at the border, those also have been resolved. And with a good monsoon, interest rate cut, tax cuts, all that put together does give a good feeling that maybe, if earnings will start to pick up and markets will not be then as expensive as they are just now.
Okay. Dipan, the other observation in the market is that markets have gone up and promoter blocks are back, IPOs are back. So do you think it's a matter of time the liquidity will start getting challenged?
No, Nikunj, I think that we are still some distance away from that. And even the kind of flow which we are seeing just now is not as much as we had seen earlier part of 2024. So I'm not that much worried about the liquidity. What has changed in the last few weeks is the positive FII flows. And they are now buying a lot into the small mid-cap stocks as well, raising their holdings over there. And as it is, liquidity requirement for those counters is pretty less. So I don't think there's much of a concern on that count. What really bothers me is the valuations and the underlying earnings growth, which has taken place in the last earnings season. And while values have remained constant or have gone up, the earnings have not matched or not kept pace. And therefore, P multiples have expanded. All I can say is I do hope that, with all the various positive fundamental factors, the earnings should improve going ahead or so, because only that can drive the stock markets higher. By and large, I think P expansion is over and done with.
Right. Okay. Let's pick up on the charts for ITC, considering that block deal is going to happen today. That stock, of course, is the one which is going to be in focus. Dipan, what do you think is going to be the implication of this sizable stake offload from BAT, which is now looking to sell about that 2.3% stake in ITC, and the supply that's going to come in?
I don't think it's going to impact ITC's fundamentals per se, or have any major impact on the stock price trajectory. ITC is a very well managed professional company, and it's not so much dependent on its parent company in terms of any major resources or so. The brands are anyway with ITC in India over here, so I don't think it's going to have a material impact. The real issue with ITC is that it is operating in many categories which are quite mature. And therefore, end of the day, if you see the growth rates for the last several years, they are pretty much flat and stagnant. And end of the day, it's kind of a tobacco company. And so therefore, its valuations also on the lower side. I've never been a great fan of ITC because of its stagnant growth prospects. So from that point of view, I want to avoid it. But from time to time, you do get very strong trading rallies in ITC. But this particular development of BAT selling their stake is going to have virtually no impact on the stock price, or for that matter, the underlying fundamentals of the company.
But what is the right way of looking at Jio Financials? I mean, there is hardly any operating business, but this whole promise that, okay, they will scale up, they will disrupt, they will be a leader in financial services, they have reached technology, data, and the brand of Reliance, and chairman like KV Kamath. Has Jio really lived up to its promise? I'm talking about Jio Financial Services.
No, Nikunj, I would say that it has been a bit of a disappointment from our perspective. and all the right ingredients are there for successful scale up, but that has not happened. I think that the industry and the sector they're operating in is very, very competitive. So whether they're getting into mutual funds or whether they're getting into NBFC lending or any of the financial products they're looking at, there's extreme competition over there. And brand and technology and team do play a role. But end of the day, this is a slow grinding business. It takes a lot of time to get the customers on board and then repeat sales and then expand the network, expand the book in a sensible and a safe manner is not that easy. So if you're invested in Jio Finance, you need to have a 5-10 year type of a view. And one cannot really expect quick results over the next 2-3 years or so. And there's so much of choice also within the NBFC space. And lately, the likes of Bajaj Finance, Cholamandalam, Shriram Transport, they all seem to have got their act in order. Their NPAs are under control. And with lower interest rates, these NBFCs are going to be major beneficiaries. So you have a choice, and it's not that just because Reliance and Jio are there, one needs to go ahead and look at the stocks in that light. So I for one am avoiding Jio. I think there are better choices within the NBFC space. But as I said, I think it's a long-term business. 5-10 years from now, there could be a major player, but you need to have the patience for that.
Right, okay. Bunch of other stocks which were active yesterday, and Concord, Titagarh, both of these stocks held out very well. Dipan, what is it that you're making of this fresh up move in defense and railway names?
So I think defense, more than railways, defense really are the absolute darlings of the market at this point of time. If you see the entire earnings season, that particular category of stocks or that segment has done extremely well in terms of revenues and profits, way better than analyst estimates as well. They're sitting on very good order book position. Management commentary also is very positive. And a lot of investors do feel that, with the kind of events that have taken place, the prospects, the long-term prospects of these companies looking good. Export markets also seem to have opened up for a whole host of public and private sector defense contractors and a lot of positive factors, but we cannot lose sight of the valuations. The defense companies are being valued anywhere from 30 times to 130 times. And those kind of valuations, if you buy these companies, even if the earnings come through, even if they grow at 25, 30, 40% or so, even then I don't think over a long period of time you will make great returns. And one needs to keep in mind that all this hype is there just now. This was a good quarter for them. But end of the day, there's been a lot of cyclicality and volatility in their earnings as well. And order inflows also are pretty lumpy. So are investors ready for slowdowns or negative growth rates in a few quarters? I think not. So right now they think it's like a nice secular growth business, but it doesn't really work like that if you look at the past 5-10 year track record. And end of the day, they are heavily reliant on government spending. And right now, I think there's a lot of noise that we should increase our defense spending. But let's see on the ground actually what happens. So as an investor in defense stocks, I remain invested. Don't want to sell just because valuations have gone up. But from a fresh investment perspective, I don't think the risk return profile favors you purely on account of the high valuations.
Setup, I think, Dipan, one needs to be cognizant of the fact that even though the global yields have gone higher, US yields have gone higher, the dollar index is well under control, currency is well under control. So can one say that as long as the dollar index remains weak and currency remains strong, which is Indian currency, we should not worry about FI activity?
I think FI generally are realizing the superior fundamentals of the Indian economy, and they are seeing that in US the fundamentals and the corporate profitability seem to be a bit challenged, and there's just too much concentration in the Magnificent Seven. So from that point of view, I think all emerging markets are doing well, and India is getting benefits of that as well. So I'm not that much looking at the global factors at this point of time, but really, Nikunj, the real important event over here is what's going to happen, in July when the 90-day period gets over, and what is going to be the Trump tariffs. That's the most important question, and frankly, the real risk factor in this nascent uptick which we have seen in stock prices. But nonetheless, I think the long-term flows of the FI seem to certainly have improved.
Okay. Dipan, if you have to pick up spots based on earnings, where are you finding a sense that a 15-18% growth looks looks conceivable for next 2-3 quarters? Where are you getting that confidence? In which name, in which sector, in which theme now?
It's a difficult sector, but I think specialty chemicals, a lot of companies did very well in this particular quarter. It is a cyclical business to some extent, and I see an upcycle in the specialty chemicals business. These companies invested heavily just around 2020, around the COVID times. They came into the limelight because of China Plus One strategy and generally cyclical upcycle. And they were all expanded capacity significantly and expanded their footprint in the global market. A lot of them have got long-term supply contracts as well. And now I think since input prices have stabilized and even the final prices have improved a little bit, I think these companies are doing well on the volume front and the price front. So within the entire space now, we are looking at specialty chemicals very closely to see if there are any good winners over there. Right now, on an optical basis, these stocks look expensive because last few quarters, the earnings have been a bit disappointing. They have been negative for many of the specialty chemical companies, but these are great operating leverages. And at some point of time, the earnings can surprise us on the upside. And from that point of view, these stocks seem to be a bit undervalued. But Nikunj, this is a very complex sector, difficult to understand, and there could be a great degree of diversity in the terms of the earnings which come through. So we need to be very careful which stocks we buy into. But if you ask me one sector which is looking promising after this earnings season, I have to say it's specialty chemicals.
Well, specialty chemicals is the way to go. But look at technology as well. You know, while you may not have had a meaningful move yet, but the Infosys ADR overnight saw a jump of about almost 2% or so. Dipan, is IT a contra call by any chance?
No, IT has now gone off the radar completely. And we've gone over this thing many times. The real reason here is that they have clearly, I think they have lost their moat. What is happening is with the kind of surge in GCCs, global capability centers, really the competitive edge of the IT software services companies has got eroded. Their clients themselves are going ahead and setting up captive software development centers themselves. So what is really the value add of a software services company? That's, I think, is being questioned. Secondly, whatever happens, it's very clear that US economy is going to be stressed for the next few quarters. Recession, depression, crash, one doesn't know, but definitely there's a great deal of uncertainty amongst US corporations. And in that kind of a scenario, they're not going to go ahead and increase their expenditure on software. So that's going to be a bit of a challenge for software service companies. And then there's this AI thing. I thought this AI was going to be a great opportunity for Indian software service companies, but it doesn't seem to be so. And a lot of those projects are very small and really not percolating down to the software services companies. So for me, the entire sector is a avoid, except for 2 or 3 outliers. You could say like a Persistent Systems, which has done exceptionally well. Maybe an Oracle, which is more of a product company. Newgen, but disappointed with Newgen's numbers, which is kind of a platform company. So there are just 1 or 2 picks here or there. But by and large, I think the traditional software services companies are a complete avoid.
Can also help us with your take on Jio Financials, because just yesterday the stock was also up around 3%. But well, of course, it did had a news flow. But other than that, Dipan, what did well was some of the laggards within the banking space. Case in point being Bandhan Bank, RBL Bank. They did pretty well in trade just yesterday. At this point in time, Dipan, where in the banking space you're finding value?
See, I think that Bandhan, RBL came with decent set of numbers, and maybe a lot of their issues are behind them. But one pocket within the bank space which did really well are the PSU banks across the board, right from State Bank of India to Punjab and Sindh Bank, the smaller banks, the larger banks, Canara Bank, Bank of India, Bank of Baroda. And if you look at their numbers, their NPAs, their credit growth, their CASA ratios, they're now all matching up to what we are seeing in the private sector, but valuations are still on the lower side. So I see that the gap, the valuation gap, the performance gap between the PSU banks and the private sector banks is narrowing very fast. So if you wanted to increase your exposure to the banks, I think the best way to play would be through the PSU banks. But if you still want to a better idea, I think it's better to do it with the NBFCs. And in a situation like this where interest rates are lower and NBFCs per se have got a lot more lending opportunities, they are far more flexible. And I think to an extent, they manage the regulatory framework far better. So if I were to increase my exposure to the lenders, I would like to do it through the NBFCs, and there are a lot of choices over there. And our preference would be for companies which are offering multi-products, like say Bajaj Finance or a L&T Finance or a Chola, which is not just into gold financing or not just into microfinance or vehicle finance, but across the board, they offer all the lending products. I think those could give decent returns over the next few quarters or so.
All right, so that's about some of the counters that you can watch out for within the banking space. But
JP Morgan is still maintaining its overweight. They've got a price target for about 1115 on LIC. But Dipan, LIC is one of those, non-starters. At 871 thereabouts, what's the call on the stock now?
See, I was very positive on LIC as a measure of disclosure. We are invested in the IPO as well and are still holding that stock. But the entire insurance space now, I think, is not really inspiring, or it's not really appealing to us. These insurance companies have been around for more than 10 years, LIC much less than that, but they haven't really, set the stock markets on fire. Their performance has been very volatile. It's been tepid. Their growth rates, although optically they look good, but when you see the stock price appreciation over a 10-year period, is nothing impressive. These are complex businesses to understand and to value. You cannot just take the price earning multiple and value them. There are many other nuances over there. But end of the day, they haven't really created a great amount of wealth for the minority shareholders. And as a business, it is heavily regulated. There's hardly any scope for innovation or one company doing exceptionally well over the other. So from my point of view, I now want to get completely underweight or nil weight the insurance sector, be it life insurance or general insurance. It's just that the track record for the past 5-10 years has not been that inspiring. And from an investor's perspective, you want that alpha, you want to beat the Sensex Nifty, get higher returns. I'm not sure that insurance companies are your long-term bet.
And great to have you on the show. We'll let you go on that note. Good speaking with you as always.
If you like this video, then like, share and subscribe to ET Now.